Hello everybody and welcome to my new video on Opendoor's third quarter. So first let me begin by saying that I realize that it's not very trendy right now to be positive. But I think there's a lot of good things to love about Opendoor's Q3. And I wanted to highlight those. And I know there are already dozens of videos on YouTube, on Twitter, on social media about how terrible Opendoor is. So please allow me to make a video as to why I think Opendoor is actually not that bad. The doom and gloom, in my humble opinion, is just too much for this company. I mean, this company is down 94% from its peak in early 2021. 94%. That's almost a 20x range. Remember that disruptors can fall down 80%, 90% multiple times. Amazon fell down more than 80% about 12 times. So although I do understand that this is market and this is normal market, the market is really overdoing it for Opendoor. I really believe that. And I hope to highlight why I think that and why this quarter, frankly, is not that bad and the company's thesis is still intact and strong. So reason number one why I love Opendoor. Macro, because let's face it, this stock is only down because of macro. Macro can change very quickly, right? I want to be in this stock when quantitative easing resumes. So it's a bet on Jay Powell's bluff. Jerome Powell is bluffing. Or if he's not, why should we believe he's not? He told us in early 2021 there was no way they were even thinking raising rates. And companies believed him to his word. And what does he do now? He raises rates. And he tells us now he's going to keep raising rates. Why should we believe him? When he told us there was no way he was thinking about raising rates, why should we believe him? I do not believe him. I believe numbers. And numbers tell me that QE will continue, QE to infinity. I believe QE is the only way because look at this. The US government today, the White House released a statement saying that they were not adjusting their budget going forward, the US government budget, because there is no recession. Are you kidding me? There is obviously a recession. But they're not adjusting the budget. They keep spending. Yesterday, $13 billion for energy bills, right? They keep spending deca billions every other day. And so what is the deficit going to be in 2023? Is it going to be just $1 trillion? I don't think so. Not with tax revenue so down. I think the deficit is going to be much higher, maybe 2 to 3 trillion. And so if the deficit is that high in 2023, which you bet they will, because with all of these layoffs, with all of these lack of capital gains from people shifting their position and shifting their stocks, revenue will be down for the tax. There will be lower tax revenue. This will dig the deficit. And who can buy? How do you buy? Who's going to buy all of these treasuries? Not Japan, not China. They have to sell treasuries to support the currency. The only buyer possible is the Fed, and the Fed will resume QE. At least that is my working hypothesis. So that's why I'm not scared about macro right now. I think they will pivot. So I think this is perhaps the most important point. You want to be in companies that are revolutionary like Opendoor when the pivot happens. And I do believe the pivot will happen. Not investment advice. Point number two, Opendoor is a network, right? It's a platform. It's a platform for buying and selling households' most important asset, their homes. But it's a platform. And platforms typically are very binary bets. They have winner-take-all dynamics. There will be one platform that will win this market. And I am betting that it's not going to be OfferPad. It's going to be Opendoor that is going to be winning this category. I think that's a fair bet to take. It's a binary bet. The company could go bankrupt if we have this crazy macro for 5 years. But I don't think that's going to happen. And so the thesis is still intact. They're still trying to revolutionize real estate. They could still be as big as Amazon. And I use that quote. What Uber did to taxis and taxi drivers, and they didn't see it coming, Opendoor can do that to realtors. I really believe that. I've been a customer of Opendoor for 2 transactions, and I loved every second of it compared to realtors. And look at the testimony, read online. You know, people who have bought with Opendoor before, like I have, and sold with Opendoor before, there's no way we're ever going back to a regular realtor. I am not ever going back to a regular realtor unless Opendoor was out of business. The experience is so much better, and I don't have time to go into the app and all of the reasons why it's so much better, but it is so much better to buy with an app and just have a random realtor come and open the door for you of the house, and you go see the house. No pushy sales tactics, no nothing. So this is so much better. I can't even emphasize enough. The product is so good. You know, when you try a product and the product is so good, that's how many people had the Apple intuition. They tried the iPhone, they loved the iPhone, they bought Apple. That's why so many people buy Tesla. They tried a Tesla, they loved the Tesla, and they buy the stock. The intuition doesn't lie. Opendoor service is so good. It is so much better. I can't talk positively enough about their service. Moving on. Reason number 3. Losses are temporary, right? So they wrote down more than 500 million worth of real estate. Well, that's temporary. They didn't realize those losses, and that's from a time where they underwrote, right, purchases of homes much higher than the market because nobody saw the market turning around this fast. I mean, nobody saw it. Very few people saw it. I mean, sure, there's always someone who says that they saw it, but they didn't. So Opendoor overpaid because the market dropped too fast. But now that's over. Like, now it's over. Houses bought in Q3 and in Q4, they are being so picky. They're only buying the homes with the biggest spreads you can imagine. They're only doing that. And so because they're buying homes in Q3 and Q4 with such widespread, they're almost buying only half of what they used to buy. So they're being very picky about the homes that they buy now. So it is going to be a temporary loss of maybe $500 million, maybe more, but the balance sheet can handle it. This is a well-capitalized company with very large financial commitments. They have very large purchasing facilities, so they can handle it. They can take that loss. It sucks. It's too bad. But is it really worth 95% drawdown in the stock? I don't think so, but the market's very short term and only thinks about next quarter right now. So I guess if you only think next quarter, the stock should be down. Let me move on. Other reasons why I love Opendoor. They're building the premier, the exclusive transaction layer. The better way to look at Opendoor, in my opinion, is to look at it as a competitor to the MLS. The MLS is all powerful in the US. They underlie the entire real estate system. Opendoor is building a new system, a competing system, with limited realtor intervention. Very, very, very limited. An Amazon-like experience, a buy now button. This is not a flipping business, contrary to what you see in a lot of videos. They don't flip homes. They just buy a home for a service fee, a small service fee, which includes their margin. That's it. That's it. That is how they make money. And they are much cheaper than realtors because if you do what I call a round trip, a buy and a sell, you'll save 1% by going with Opendoor. So a round trip costs you only 2% and 2%. It doesn't cost you 3%. 3% is the usual that realtors charge. So you save both ways when you go with Opendoor for both your buy and sell transactions whenever you shift homes. Americans shift homes on average 7 times in their lifetime. This is a tremendous business. And Opendoor saves money by undercutting realtors. Moving on. Outstanding execution. Did you know this? They've launched exclusive. I don't know if your Opendoor area, I don't know if where you live has exclusives, but where I live has exclusives. And exclusives is very compelling. The prices are very compelling. They list the homes before they reach the MLS. And in places where they've launched exclusives, in the terrible market that we have right now, they're selling 1 out of 5. 1 out of 5 home listed as an exclusive is selling on their platform without reaching the MLS. So that is a very, very powerful offer. And you can bet this number will increase because buyers, savvy buyers, and most real estate buyers are savvy, right? That's why you get to buy a house, because you're probably a little more business oriented. They know that Opendoor has exclusives, and just because Opendoor has exclusives, you have to have an Opendoor app. Just like streaming platforms, because a streaming platform has that one show, you have to have that streaming platform. The same is true for Opendoor. The Opendoor platform has a large proportion of homes. If you want to make sure you buy the best home, you have to have the Opendoor app. Then lastly, did you know this? They sold about 1,800 homes to institutions. Institutions are smart. They know real estate is not going anywhere. They know it's a good investment, and they want in on the action. And so they're buying homes directly to Opendoor. It's easier for an institution to deal with Opendoor because Opendoor can sell 200, 300 homes all at once. So I think this is something that they're going to be building up, and institutions will buy homes. Very powerful. This is new. This is new over the past 3 quarters. This is what has happened. Moving on. The revenue is still, despite everything that's going on, the revenue of this company is still up almost 50% year over year. When you have a company that grows 50% year over year, when you have a company that grows that fast, that allows some room for error. Because as the as the revenues compounds, your earnings, you will get enough leverage to a point to which your earnings will grow even faster. So companies, what if Opendoor can grow at 40 to 50% for the next 10 or 15 years? Imagine the insane returns that a company like this could provide. Revenues are still up 50%. Most companies that I invest in, that I look at, I want a revenue up 50%. And I love that. And sure, it will go down because they're going into a slowdown mode right now because they realize the market is crazy. And so they're spending that money. But as soon as QE resumes, Opendoor will resume its activity. So I really, really believe that. Then they're taking actions. Purchased homes and inventory is way down. 45% fewer homes compared to Q3 2021. Why? Because the offers that they send out, the very few offers that they send out now, because they reduced their marketing budget. But the offers that they send out now are very low. You can bet they are offering much lower pricing on all of the new people who go on their website and try to sell their homes. And so there's less stake. If you're a home seller, you're less likely to take an offer that's low. But Opendoor is being picky. It's giving lower offers to be sure that it will have a spread big enough going forward. That's why the problem is a Q1, Q2 problem. That loss is a Q1, Q2 loss. It is not like that going forward. They have learned their lesson. Quarterly loss, 570 million in paper loss. It's a paper loss for now. So sure, they will realize, that loss. But do you know that they will have realized all of the losses before the market turns around? Does that make sense? It's like, are they going to sell everything at a loss? How fast are they moving homes? The market may turn around next year, and there may be homes that did not sell at a loss. So it's still a paper loss. Like I realize, sure, many of these paper losses will probably realize, but we got to keep in mind that it's a paper loss. Cash, the loss has not been booked yet. And so pivot can happen at any time by the Fed. Something can break and the pivot can happen. And as long as the loss is not realized, as long as it's just a paper loss, there is hope. Hope is not a strategy, but I'm perfectly okay with that loss, given their position and given how low the stock price is. The stock price is so low. Okay, yeah, sure. They made $500 million in losses. They may have $1 billion in losses, but it's the potential is still the same. The balance sheet can handle it. All right, we move on. Real estate market. Do we really think that a real estate market will be down for many, many years to come? That's fear. That's fear mongering. Real estate goes up. It always has, and I think it always will. And it goes up because we print dollars much faster than we print homes. It goes up because people love homes. People are willing to spend more on homes. so many reasons why real estate retains its value. Go back to a Sears catalog and look at how much Sears homes used to cost in the early 1900s. They used to cost $1,800, $1,900 was the price of a full home that you would buy on Sears with contractor and everything. So real estate just tracks monetary inflation really, really, really well. So in nominal terms, real estate will go up. In real terms, it's probably flat, but in nominal terms, it will go up. So real estate will go up, will adapt. It's not gonna die, right? People need homes. You can't delay a purchase of home forever. Single family homes are an emotional purchase. There's a lot of reasons that go into buying a home that are not always rational. People need homes. Like, that's the most important thing. Okay, real estate will adapt. Let me go on. Why will real estate adapt? Well, look at what's happening with the mortgage market. Banks, Wells Fargo the other day announced a 15% layoff in mortgage bankers. Mortgage bankers are struggling right now. So they're coming up with offer to be able to keep doing their job. So what happens with rates on the 30-year being at 7.5%? So what happens when you have that? Well, guess what? More people think about a 15-year mortgage. That's something people do, especially if they've been saving in cash, right? A lot of people, and I maintain that many buyers of real estate are savvy. They will go for an adjustable rate mortgage, a 5-year, 7-year adjustable rate mortgage. And when the 5 years or 7 years are up, they refinance, making the bet that rates will actually be lower in 5 years or 7 years from now. So I think ARMs are very interesting. There's a lot of incentives everywhere. Incentives on closing fees. Sales teams are giving a lot of incentives right now for people getting mortgages because the business dried up. So it's not like mortgage lenders are not adapting and not changing their products and letting real estate just die. No, that's not how it happens. These companies are dynamic. They adapt to the environment. What else? Supply. Few are selling their home. Like at this point, if you have a 3% or 2.9% 30-year fixed mortgage, you are very, very unlikely to let it go. And so you're going to sell your home only if you're forced to sell your home. So we saw that back in 2012, 2013. People had gotten really cheap rates, and so they wouldn't let go of their homes. And then households are very aware of the value of real estate. If anything has shown over the past 3 years, if anything has been shown to households, is that real estate value really goes up. And who hasn't looked the price of their home on Zillow or on Trulia this day? Who doesn't track that? Which household doesn't track that? I would argue most households are hyper aware that real estate has kept up with monetary printing and kept up with inflation. So I don't think real estate's going anywhere. And in nominal terms, in dollar terms, real estate, I do believe, will go up and will keep going up, not investment guys. Let me move on. Reason number 10. Let's look at supply and demand of single family homes, which is most of what Opendoor does. So there's 84 single family homes in the US, only 84 million single family homes in the US. The whole might of the US economy, the best economy in the world, very, very best, can only build 1 million single family homes a year, and way less right now. There's 84 million homes. You can only add 1 million homes to the supply. That's it. That's all you can do. So what do you think will happen? Well, that's a 1% new supply increase every year. That's not a lot. That's not a lot increase every year. Physical stuff like a home retains value because they don't print it. You can't print homes. That's why it retains value. That's why households want to buy them. But what about the growth in the US dollar? Well, I've told a lot about it, but how fast are they printing US dollar, right? Historically, broad money, if you go back to the 1960s, historically it's grown at 7.5%. And I argue that monetary inflation with QE will come back. They will grow the supply of US dollars again. And so real estate is a wonderful investment. It is a wonderful investment. It should be part of anybody's portfolio. And I don't think that's going to change. People are fully aware of the value of real estate. I just don't think that's going to change. And so to bet that real estate is going away is just silly right now, in my humble opinion. So moving on. Opendoor is in what I call hibernation mode. They're saving money. They're realizing that the market gives them no credit right now. They're realizing that the Fed is raising rates and really hurting the economy right now. So what do? They slow their growth. Only very, very, very low offers when you buy. That's what they do. They've slashed their marketing. Fewer letters, almost no letters. I bet you don't receive many letters in the mail from Opendoor anymore. You used to receive maybe one letter a week, so almost no marketing. And they're just waiting it out, waiting for the pivot. That's my opinion to what they're doing. And I love that. I think it's a pretty smart thing to do. Only do a transaction if you know you're going to make enough money because you have high spreads. Only do a transaction that is safe, that has a margin of safety. That is what they do. And because they are slowing down their growth, what did they do? They're laying off their workforce, 550 employees. That is very sad. But that's what they're doing. That's what the Fed's trying to do by raising rates. They're trying to slow down the economy to kill inflation. Well, with all these tech companies and companies of all sorts, of all kinds, not just in tech, announcing layoffs, I guess they may be solving the supply problem. We'll see. Okay, reason number 12. So now that they slow down their first party purchase section of the platform, buy and sell, that's first party, most people don't realize that Opendoor actually has one of the top apps for buying real estate, a bit like a Zillow. So their app for buying and selling real estate is what they're going to focus on right now. And they're going to ameliorate the app and focus on the third-party app because it's a very successful app and people looking for homes may get on the app and go through their third-party marketplace. So they're prioritizing right now slowly third-party apps, third-party sales, prioritizing that and waiting for the slowdown to stop, which I believe it will inevitably stop. Real estate will go back up. And then lastly, and this is the sad one, in my opinion, but recession. I remember I've been following Opendoor for a long while. I remember listening early days conference calls, 7 quarters, 8 quarters ago, where the CEO was talking about how Opendoor was built for a recession. Because unfortunately, when you have a recession, this is where people give up their homes at very, very low offers. Because a seller may have lost their job and they have to sell. Maybe there's some hardship going on. Maybe we have more divorce during recession and they have to sell. Maybe you can't afford the new cost, the mortgage, the inflation, and you have to sell. This is very, very sad, but this unfortunately may allow Opendoor to get great spreads. And I'm not happy about this. I really don't want a recession. But in a recession, remember 2008, although we're different from 2008, but remember 2008. Lots of people were forced sellers. There is no denying that recession increased forced selling. And so Opendoor becomes very appealing when someone else has no choice. And this may actually lead to much wider spread for the business that Opendoor is willing to make. And lastly, it's unfortunate they've laid off people, but as unemployment rises, as the Fed is creating this recession, as unemployment rises, they will have a greater pool of applicants and then can hire the very best applicant. And when you're a software-based business, hiring the best engineer is so much better than hiring the second best. Software businesses have winner-take-all dynamics, and you got to hire the best. And so, better applicant pool. When you see all of these companies laying off, Opendoor, as it resumes growth, may have a much better applicant pool and may be able to benefit and hire an even better workforce. So that point number 13 is a sad one, and I don't like it, but it's just the way it is. So Opendoor, these are the 13 reasons why I love Opendoor and why I think Opendoor is one of the most disruptive plays out there. And of course, it's binary. Of course, Opendoor could go bankrupt if the Fed goes on with raising rates for the next 3 years, 5 years. But I just think there is no way they will do that. It's the numbers just don't add up. You can't keep raising rates without breaking things, and the deficit will have to be financed, which means that QE will have to resume. That is my working hypothesis. Again, not investment advice, never investment advice, but I am very happy to be a shareholder of Opendoor. And thank you so much for watching. I appreciate it if you can like and subscribe. Thank you so much for watching. Good luck with your investments.